Hello traders, frustrated with losing money in trading? In this video, we'll walk you through the 5 secrets of successful traders, explaining each step in detail, and provide you with the tools to achieve success in trading. The 5 essential points we'll explore in this training are critical disciplines to adopt if you want to achieve long-term success as a profitable trader. As promised in the title, today's video will dive into the 5 essential points that will help you achieve success in trading. First, let's talk about patience. I'll break down why it's a crucial trait for profitable trading, and then I'll share practical tips on how to develop it. Consistency, the key to long-term trading success. Learn how to maintain a consistent approach to maximize your profits. Emotional control, trading with a calm and professional mindset. Risk management, how to protect your trading capital. Fundamental analysis, key indicators for informed decision-making. The first step to becoming a profitable trader is patience. But what does patience really look like in practice? Again, let's define what patience means in trading. Patience is about waiting for the right market conditions to make an informed trading decision. Let me give you an example of what impatience looks like in trading. Let's imagine a trader named Alexandra. Alexandre is a beginner in trading and is very enthusiastic about making quick profits. He has opened a trading account and has started buying and selling stocks without really understanding the market fundamentals. Alexandra is impatient to see his profits grow. He wants to make money quickly. He starts making impulsive decisions, buying and selling stocks without thinking, following market trends without understanding the reasons behind them. As the market starts to fluctuate, Alexandra becomes nervous and begins to make even more impulsive decisions. He sells his stocks too quickly, buys unprofitable stocks, and starts to lose money. Despite his losses, Alexandra refuses to admit he's wrong. He continues to make impulsive decisions, continues to lose money. Eventually, Alexandra ends up with an empty trading account and is forced to close it. This is a classic example of an impatient trader. Alexandra let his emotions guide him, made impulsive decisions, and lost money. If Alexandra had been more patient, he would have taken the time to think, would have analyzed the market more thoroughly, and would have made more informed decisions. Here are some key tips to avoid finding yourself in the same situation as Alexandra. Patience in decision-making. This is essential to avoid impulsive decisions and take the time to reflect. Don't trade every day. This allows you to avoid being driven by emotions and make more informed decisions. Focus on high-quality trades. This is preferable to taking reckless positions, as it increases your chances of success. Opt for swing trading. This style of trading allows for longer-term positions and capturing more significant price movements. Remain patient during the trade. This is crucial to allow the market to reach your take profit and avoid closing the position too early. Trust your process. This is essential to avoid doubting your decisions and stay focused on your goals. And finally, step away from screens from time to time. This allows you to gain perspective and avoid being swept up in emotions. Consistency in trading refers to a trader's ability to consistently and predictably apply their trading strategies, rules, and processes. This involves maintaining a disciplined and methodical approach to making trading decisions, rather than reacting impulsively or emotionally to market movements. Here are some key elements that characterize consistency in trading. 1. Clear trading strategy. The trader has a well-defined trading strategy and understands how it works. 2. Precise trading rules. Trading rules are clearly defined and consistently applied. 3. Repetitive trading process. The trader follows a standardized trading process for each transaction. 4. Consistent risk management. The trader applies consistent risk management to each transaction. 5. Continuous evaluation and adjustment. The trader regularly evaluates their performance and adjusts their trading strategy and rules accordingly. Emotional control in trading refers to a trader's ability to manage and regulate their emotions to make rational and objective decisions. This involves recognizing and understanding how emotions can influence trading decisions and implementing strategies to manage them. Here are some tips to help you develop emotional control in trading and increase your profits. 1. Recognize your emotions. Identify the emotions that affect you the most while trading, such as fear, greed, or frustration. 2. Develop an emotional management strategy. Implement techniques to manage your emotions, such as meditation, deep breathing, or physical exercise. 3. Establish clear trading rules. Define precise trading rules to avoid impulsive decisions based on emotions. 4. Take a break when necessary. Take a break when you feel emotionally charged to avoid making irrational decisions. 5. Analyze your performance. Regularly evaluate your performance to identify emotional patterns that may impact your trading decisions. 6. Practice discipline. Consistently apply your trading rules and emotional management strategy to develop the discipline required for successful trading. 7. Learn from your mistakes. Analyze your mistakes to understand how emotions may have influenced your decisions and adjust your strategy accordingly. Risk management in trading refers to the set of strategies and techniques used to identify, assess, and control the risks associated with trading operations. This involves taking measures to minimize potential losses and maximize gains, while considering trading objectives, risk tolerance levels, and available resources. Here are some tips to improve your risk management in trading. 1. Define your trading objectives. Identify your trading goals and risk tolerance level to determine the most suitable risk management strategy. 2. Assess the risks. Identify potential risks associated with each trade, such as market risks, liquidity risks, and credit risks. 3. Use protective orders. Use protective orders like stop loss and take profit orders to limit potential losses and lock in profits. 4. Diversify your positions. Diversify your positions to reduce the risk of loss in case of an adverse move in a specific market. 5. Manage your positions. Manage your positions by adjusting position sizes, closing underperforming positions, and rebalancing your portfolio. 6. Monitor your performance. Monitor your performance to identify areas for improvement and adjust your risk management strategy accordingly. 7. Learn from your mistakes. Learn from your mistakes to improve your risk management strategy and avoid repeating the same mistakes. By following these tips, you can improve your risk management in trading, reduce potential losses, and maximize gains. Fundamental analysis is a method of financial analysis that involves evaluating the intrinsic value of a stock, bond, or asset by examining the fundamental factors that influence its performance, such as financial statements of the company, balance sheet, income statement, etc., economic and sectoral situation, company management and strategy, growth and profitability prospects, financial ratios, profitability ratio, liquidity ratio, etc. Benefits of fundamental analysis. 1. Accurate valuation. Fundamental analysis enables investors to estimate the intrinsic value of an asset, helping identify buying or selling opportunities. 2. Informed decision-making. By examining fundamental factors, investors can make more informed decisions, less influenced by emotions. 3. Risk reduction. Fundamental analysis helps identify potential risks associated with an investment, allowing for measures to mitigate them. 4. Improve performance. Selecting solid investments and avoiding potential pitfalls helps investors enhance their long-term performance. 5. Development of an investment strategy. Fundamental analysis aids in creating a personalized investment strategy tailored to the investor's objectives and risk profile. And that's a wrap. We've reached the end of this video on the keys to success in trading. We've covered 5 essential points: patience, consistency, emotional management, risk management, and fundamental analysis. These 5 elements are the foundation of a solid and sustainable trading strategy. By incorporating them into your practice, you'll be able to improve your results, reduce your risks, and achieve your financial goals. However, remember that trading is not an exact science. There will always be unpredictable elements and associated risks. That's why it's essential to remain humble, continue learning, and adapt your strategy to market conditions. If you found this video helpful, don't hesitate to subscribe to our channel for access to more high-quality content on trading and financial management. We wish you the best of luck in your future investments and trading.